Good afternoon, everybody. Welcome back to the Opportunistic Trader. We're joined by Jay Collins of the Trean Group. Jay is a floor trader. He's been on the floor for over 25 years now, and he's worked closely with Larry for a number of those years. How's it going, Jay?
It's going well, Mike. Thank you very much.
Yeah, thanks for joining us, giving us some information. Actually, if everybody can hear in the background, I hear the floor, which is great. It's great to get some, old school floor noise in the back. So Jay, what's it like on the floor right now?
It's been a fairly quiet day right now, but overall, I mean, we're still alive and kicking down here. We see some pretty fair activity. I'm over in the S&P options at the CME, and we still do see some pretty good activity in the pits down here. The reports of our demise, should be dismissed at the moment.
Yeah. So
You know,
tell me about that. So what's the edge of customers calling the floor opposed to everybody's so accustomed to electronic right now?
well, a lot of times if you go to electronic market, I mean, what you're going to get with the electronic market is just a plain vanilla quote. You're not going to get any hand holding. No service is going to be provided with it. Generally, when you come to the trading floor, most of what we're seeing trade on the floor these days is the options product more than the futures. The S&P options on the futures are extremely active, and if you want to trade and get off some really good size, you're going to find a better market in the pit than you will on the screen. I mean, the screen will reflect a market that might be a nickel or so tighter. But if you're looking to move 500 big contracts or 2,500 minis or 5,000 minis, you will by and large get a better shake out of the pit than you will on the screen.
Yeah, probably also on the screen, Larry and I find a lot is that you get a lot of algos. So it might be showing, hey, 500 on the bid or this or that, but you actually go to hit a few and they all disappear. Whereas on the floor, I guess you get some real size and some real orders.
Yeah, it's kind of funny you said that. I remember, a few years back working some orders for Larry to execute in the E-minis for him in the futures end, and we'd go to lift an offer maybe 1,000 times or 1,500 times, and while the screen would show that there was 1,700 there, you'd end up with 380 of them. I'm not really quite sure how that works, but all signs seem to point to the algos just layering orders in, and once they'd start to get some filled, they just pull the balance out. Instead of getting filled on everything, they'd pull out and then start to front run whatever you were trying to do. So,
Absolutely.
with the trading floor, we don't see that as much anymore. I mean, the trading floor got a black eye in the past with some of its reputation, and maybe some of it was earned. But, I think that what we see with the algos and electronic markets is on a par with what people used to feel about with the trading floors. In some extent, far worse.
Yeah, absolutely. And so tell me that since you're talking about that, how's the floor changed, like, let's say 15 years ago versus 8 years ago versus now?
15 years ago, I mean, it was the Wild West. I mean, we still had an extremely active futures markets on the trading floor of the S&P futures. We're still trading 150, 200,000 big contracts a day. And we saw the E-minis, traded at a large number as well. I mean, they were both active markets. The E-mini at that point in the futures end was actually a great liquidity provider, and actually to this point is still a very good market to trade on the futures end. On the options end, it hadn't developed much at all. It is now, 2008, we saw it start to shift. We had a Lehman debacle. Volume greatly moved away from the futures pit. You saw a lot of the large pension plans, which use the futures, move out of their portable alpha strategies, trying to replicate the S&P and earn a little extra on fixed income. A lot of them moved out of that. It decreased the open interest in the futures pit and, kind of hastened the quick demise of it. Now the futures pit for the S&P 500, it still exists. We still see some trade in there, but it's not very much. I mean, now we probably see 1,500 to 2,000 contracts a day trading it versus 2008. We probably saw about 80 to 100,000, and versus 2003, as I said, probably 100 to 150,000 on a normal day. And on a busy day, you'd see 200 to a 250,000 contracts trade.
Wow. And you're saying how many are you seeing a ballpark now?
2,000 in the big S&P futures.
Wow. And yeah.
You will see there are large institutions which still hold a big futures position, and basically just modify their positions periodically here and there, but they will roll their positions in the futures pit. The S&P futures roll is still a vibrant market with good activity on it. But for the daily, day-to-day activity, that is where we see it has decreased on the futures end.
Well, on that last point that you just made, so who are the typical guys that you're dealing with now? Is it funds? Is it independent traders? Who's using the floor the most right now?
For the most part, it's funds. It's almost always funds at this point using the trading floor. Independent traders on the smaller variety will gravitate to the screen to trade the E-minis. For what we deal with down on the trading floor, it's all, whether it's a hedge fund, a CTA, or a large institutional fund, a money manager for a pension plan. That is what we're seeing on the trading floor as far as the futures go, and the options pit, pretty much the same client base.
Yeah, yeah. So tell me about, like February, this past February, things got really active. VIX popped, got as well, I think all the way up to about 50, a little past 50 actually at one point intraday. It was really active. Were there opportunities to arb off of the screen versus what you were seeing on the floor in that sort of fast market?
The market was so fast in February, that week and a half, and even for a couple of weeks after it was still extremely fast, but not like that week, the first week of February. As far as arbing opportunities, it was truly a case of let the buyer beware. You didn't know how your fill was going to be one way or another. The E-mini futures might have been offered at 26.04 even. You'd buy it in the pit at 04 even, sometimes it's 04 and a half, and before you could blink an eye, the E-minis were 3 handles away.
Yeah.
Things moved so quickly. It was the locals in the pit who try to do an arbitrage between the big S&P and the E-minis. They really backed off quite a bit because it was just so hard to gauge where the market was going to be from time to time. And as we talked about those algos before, what we did see is, and what you will see every time you see a volatility spike, is the liquidity providers of the algos stop providing liquidity when you see high volatility spikes. Right. You'll see 400 up on the bid ask shrink to 70 up or less, and the depth of book also likewise decreases very dramatically. So that is part of what we saw at that point. And it was really kind of a crapshoot no matter which market you went in to go into. We also execute a large number of E-minis for clients on the trading floor on their behalf, and the slippage you'd see on the screen, it was troubling.
Yeah, absolutely. Like you said, the two key things that we saw, especially in February, were that size. I mean, if maybe S&P was 500 up or 300 up typically, or with 1,000 in the box above and below, I mean, they were a tenth of that because the algos tend to probably make most of their money when the market is not moving, just scalping off the bid and the offer. But when things are moving is when they get crushed, and so they back away.
Yeah, I mean, that's our kind of view on it also. I mean, there were times we'd have to go in to buy 500 or 1,000 minis for a client, and it's kind of hard to do when the book is whipping around with that little activity on it. You throw a 400 or 500 lot mini order on the book, you're going to see it move. So, it made for tough circumstances, and the pit was of a like mind. It was very difficult to trade in during those days. I mean, we saw probably your best arbing opportunity was in the S&P options at that point. There were times where you had clients liquidating on the screen and you could get it off in the pit. And it was also happening vice versa, where you had a couple large funds who had to liquidate in the pit, and the slippage was, because of the volatility spike, it was huge.
Yeah. So you're most active often around, with a lot of options, and then I guess with S&P expirations, things of that nature?
Yes.
So how do you guys add value around the options expirations?
Well, at the options expirations, we try to keep a close eye on what's trading in the pit. A lot of our activity that we're seeing these days is on the call ratio and put ratios, and then you have a large contingent of premium collectors. We have a pretty steady pulse on what people need to do on the sell side on the premium collect end. Especially going in the last couple of days, you'll see customers come in to sell a week out option, and they might have 5,000 or 7,000 to do. We have a general idea of how much they have to go just based on what they've done in the past, watching what's going on in the marketplace. And, just, instructing our clients, we might be able to buy some puts right here, but we also might, if we hold off, we might be able to buy a 25 or 50 strikes higher the same option for the same price.
Right, right. Yeah, it seems like that's especially where there's a lot of edge. There's a lot of when you can see the flow and being able to come out and be able to help find the right seller and buyer, helping everybody out.
Yeah, and that's a lot of it. I mean, it's just experience and knowing what transacts in the pit and how it's going through, and just keeping an eye for the patterns. There are certainly days where you see the market in options. You'll see the short-term expiry options. You'll see the vol spike on them in the morning, and you have to realize that either you can participate right away because it's probably going to run away from you if you need to buy some protection, and then come back later in the afternoon. It should start to come back a little bit, but a lot of times when you get those events, it will not come back entirely. So just kind of getting a read on how it goes early in the morning. If there's a lot of institutional demand for tail risk protection, how that's going to go.
Gotcha. So take me through, what do you guys see in terms of what sort of technology is on the floor right now? Like, what are you looking at when you see the market? Like right here, we're at 92 in the S&P. What are there screens everywhere, and or is it telephones, computers? Like what's on there?
There's a lot of telephones and screens. I mean, everybody's got a monitor in front of them. Most desks have a platform to trade electronic futures, as well as the pit traded contracts. And, all the market maker groups down here in options, obviously they have their technology to see what's trading in the E-mini options, E-mini futures, so they have the capability as well. Everybody down here is kind of presented with the same information as upstairs. The only thing we might be missing down here would be a little more news information, news flow. But, everybody does have their computers in front of them.
Yeah.
You're hard pressed to find somebody on the trading floor if they're working down here without a computer and an internet connection to try to get some kind of flow information.
I want to get you guys strapped on with a camera so we can get some live action, around 9:30 in the morning. Jay reporting live from the pit, get the hand signals and see some action in there. We'll have to work on that one.
That's certainly one thing that has changed over the years. There is not a lot of the hand signals as much anymore. That has kind of gone by the wayside. Most orders are transacted via headsets into the pit just so that nobody sees your order going in.
That's funny. Larry always talks about all the different, what it was like in the pit, 25 years ago, and how it was literally like a mosh pit. Like, in a way you had to be physically fit, or at least not necessarily, but a big guy throwing elbows around, was part of, that was part of the job as well.
There was a lot of beef on the trading floor 20 years ago. That is for sure. I mean, you saw a large influx of college football players end their career in the college football ranks, and
offensive linemen.
Trading floors, a lot of offensive linemen would come down the trading floor. You had to protect your spot and your client base, and those were the guys that took up a lot of space. It was hard to move them out of the way.
Yeah, I bet. So give everybody two as clean as you can, yet colorful stories of Larry Benedict. He was asking for that. Slightly scared asking for it, but he said Jay's seen it all from Larry Benedict over the years.
Wow. Larry was fun to work with. He was a lot of pleasure to deal with. And I think one of my fondest stories was there was a trading firm on the trading floor, a brokerage firm where the guys who ran their desk could trade for their own accounts, and they had put a position on in the S&P futures. And it's funny because I was telling the story this morning to somebody, and this client, this desk, their desk guys had put on a small personal position, and then they kept offering orders to make the market believe that their firm had a client order. It was a large size, and they'd offer to mark it down a little bit, and then they'd pull it out. It did this about 3 or 4 times, and Larry just finally had enough and said, the next time they do this, I'd like you to lift their offer and then see if they want to, trade any more. We'll lift their offer for whatever they have, and we'll see what they have. So we discreetly communicated to our broker that the next time that the seller came in and offered a 50 lot or 100 lot in the big S&P futures, he didn't need to ask, just buy the offer and then tell us what we had bought, and then we could transact from there. And the seller came in again and offered a 50 lot in the big S&P futures. They offered it down a tick and then 2 more ticks, at which point our broker just said, I'll buy them. He bought the 50. I informed Larry of it. He said, all right, bid that price for 50 more. Okay, I'll pay 20 cents higher. I'll pay 30 cents higher. I'll buy more. He took the risk on for himself and his firm. The other side was not happy. There were a large amount of daggers thrown in our direction, but it proved a point, and the playing with the markets ended from that desk for a while.
Yeah, I bet.
Yeah.
I bet.
So, Larry liked to police things a little bit, keep people honest. And that was a good time.
Yeah, actually, Sunil, who used to work with Larry, is in the chat. Wanted to say hi. He echoed similar sort of things of, "Hey, if I could only, I got to keep it PG rated here, but there's nothing PG rated between Jay and Larry."
Sunil and I had many and entertaining conversations, especially after the close, when Larry would mark a fill that he didn't care one way or another, and write notes on it about Jay owes me this or Jay owes me that, and then Sunil would change a Larry to, all right, this is the price. Larry was always good. He was a stand-up guy who took what he got. I mean, there were times he wasn't happy. He thought he may have gotten a bad fill or something like that. But if you're a professional trader, back in those days, Larry was the ultimate contrarian. If everybody said the spoos were going to go up 130 handles, Larry's the guy who's willing to step in there and say, you guys are crazy. You're all the same way. I'm going to go the other way. And he slung it. And, there may be people who would think, he was insane. But there was one thing that was universal, was the respect that his former colleagues and people had for him as far as the trading goes. He was, I can tell you, of the thousands and thousands and thousands of orders I did for Larry, never once did he sit there and say, that's bull. I'm going to hang you guys, or I'm going to do this or that. He traded like a man and took it like a man, but the good days and the bad days.
Yeah, absolutely. And he talks about a lot of those stories. The good old days.
What was interesting with Larry was that the better the day or the week was going for Larry, the angrier he got.
Absolutely.
And the worse the week was going, the more docile he got. It was a very interesting dichotomy.
It is.
Unfortunately, there were a lot of angry weeks.
Right. It's sometimes you think it's the opposite, but absolutely right. You'd be like, wait a second, that guy lose a ton today? And you're like, no, it's actually a great day, and he's going nuts. Yeah.
He had that's when he knew he had his edge. And he always used to say, I need to get angry so I start trading better. Yeah. And, he was never horrible or mean-spirited or anything about it. Larry was, he'd vent, he'd get frustrated and vent, but, he'd come back later and, easy peasy.
Right. All right, so on a different topic, what do you think here, markets? Any views on the markets these days?
Well, Mike, I've been looking at the S&P for 10 years now, and for a good portion of that, thought, well, at some point this rally's got to end, and here we are 10 years into it almost, and the rally it's still going pretty good.
Yes,
it's we're seeing volatility. It's kind of hanging in the low teens right now. I mean, it's been there for a little while, since February. It's never been able to get back down to that 10% mark, really, that we saw pre-February. And I don't know that we're going to see it going forward. It's a lot of people on edge. A lot of people still worried about, what the future holds. Certainly we have administration questions here in the U.S. geopolitical risks. So there's no shortage of things that could always short wire this whole thing. But right now, I mean, the more people doubt this market, the more I believe it'll go higher. Much from what I learned from Larry. I mean, if everybody's telling you it's going one way, I'd really like to go on the other side of it.
Yeah, they continue to call it the most hated rally, and it continues to grind higher. Today, as an example, we're just trading. I guess we're about 25 handles off the low. Looked like we're maybe getting the bears a little bit of action with the beginning of September, and here we are, boom, 25 handles higher.
Yes. Yeah, so I mean, I guess overall, if I had to give you an opinion on this thing, I'd be a little bit bullish on it. Not really bullish, but I'd be a little bit bullish. But I'd temper it. I'd certainly have some protection of the downside in case it turned to go the other way.
Yeah, good information. All right, well, thanks a lot, Jay. So that's Jay Collins from the Trean Group, floor trader. A lot of great information. If you want any information, actually, we'll put Jay's contact information on the site, but it's the Trean Group. But Jay, thanks a lot for joining us.
Thanks, Mike. Take care, and give Sunil my best. I missed our conversations, and it was great talking to you guys.
All right, talk to you later, Jay. Thanks.
All right, thanks.